Bismillahirrahmanirrahim. Islamic finance students, uh, today's lecture will be a revision lecture since we have completed our coursework or the topics that we were supposed to cover. So all those topics have been covered. So today we'll be talking about this revision lecture is basically based upon Murabaha. So we'll only cover Murabaha today in this lecture. So what we covered in our lecture before will be revised. So we have already discussed the basic features of Murabaha financing, and then we discussed different issues which are involved in Murabaha financing. So let's start with the definition of Murabaha. Murabaha is a particular kind of sale where the seller expressly mentions the cost of the sold commodity and sells it to another person by adding some profit or markup on it. So remember this thing that मुराबाहा is a specific kind of sale. ठीक है, सिर्फ वो सेल जिसमें आपको अपनी कॉस्ट डिक्लेयर करनी होती है. That kind of sale is the seller declares that kind of sale in which the seller declares the cost of the product is called murabaha. The profit on murabaha can be expressed in terms of ratio of cost or lump sum amount, right? So since the seller is disclosing the cost and then he has to mention that what amount of profit he is charging on that product. So that profit amount, the amount of profit of that is called markup. It can be expressed, this markup can be expressed in terms of lump sum amount, or it can be in terms of percentage as well. For example, the Islamic banks, when they sell some product on Murabaha, they generally charge in terms of percentage that 2% or 5% of the total cost will be charged as the profit or markup by the Islamic bank. But from Islamic perspective, from Shia perspective, it is perfectly fine. You can either charge the profit or markup in lump sum, or you can charge in terms of percentage. Now here is an example of Murabaha. A purchased a pair of shoes for rupees 100. He wants to sell it on Murabaha with 10% markup. The exact cost is known in this case, so this Murabaha sale is valid. The second example, A purchased a ready-made suit with a pair of shoes in a single transaction for a lump sum price of rupees 500. A can sell the suit including shoes on Murabaha, but he cannot sell the shoes separately on Murabaha because the individual cost of shoes is unknown. So remember one thing, that for uh, validity of Murabaha, you need to know the cost, because declaration of cost is one of the condition, or it is a requirement for a Murabaha sale transaction. So in those transactions where the cost is uncertain or the cost is not known, then in those cases you cannot uh, execute a Murabaha uh, contract. In those cases you can sell the product without reference to cost, as we generally see in the markets, that when we go to the shops, the shopkeepers are selling, they are just giving us a price and they are not bound to tell us the cost on that. So if we find the price suitable, we accept that price. If we don't find the price suitable, we can bargain on that price. But generally, all around the market that we visit, all around the shops that we visit, the shopkeepers, they don't tell you the cost, they just tell you a price of that product. So without reference to the cost, the sale can be conducted and it is also a valid sale. But if we talk about Murabaha, it is that only that specific kind of sale where you have to declare the cost. Now some features of Murabaha, as well as we will discuss that how Murabaha is used as a mode of finance by the Islamic banks. So one thing that should always be kept in mind is that originally Murabaha is a particular kind of sale and not a mode of financing. The ideal modes of financing according to Sharia are Mudaraba and Musharaka, that is partnership, and we have already covered these in our course. In some areas of financing, the contemporary scholars have allowed, subject to some conditions, the use of Murabaha on deferred payment basis as a mode of financing. So now if we want to use Murabaha as a mode of finance, then we need to Keep these conditions in mind. Number one, Murabaha is not a loan given on interest, it is a sale of a commodity. Being a sale and not a loan, the Murabaha should fulfill all the conditions of a valid sale transaction. So we have already covered the requirements of a valid sale in one of our previous lectures. You can refer to that lecture where we discuss the conditions of a sale. In general, three conditions are most important. Number one, the ownership of the asset, the possession of the asset, and the existence of the asset. These are the requirements for a general sale. So all these three conditions are equally valid for Murabaha as well. Murabaha cannot be used as a source of financing for paying the price of commodities already purchased. So it has to be a genuine sale transaction where the commodities are purchased for the first time. The financier may have owned the commodity before he sells it to his client. As I told you, this is one of the requirements of the sale, the ownership and possession of the asset. So commodity must have come into the possession of the financer, whether physical or constructive. So we have already discussed this thing, the difference between physical possession and constructive possession. Again, just to recall the concept, I explained this difference between physical possession and constructive possession. In physical possession, the asset that you are offering for sale is in your physical possession. For example, if you want to sell a mobile phone, that mobile phone is with you, and you can show it to all those who are interested in purchasing that mobile phone. Then in that case, that is your that 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 is your physical possession. In case of constructive possession, the asset is not physically available with you. If we take the same example of mobile phone, it might be available at a shop of your friend. You have given it to one of your friend who owns a mobile shop, that you want him to sell it on your behalf. Now, although this mobile phone is not physically with you, but since the ownership of that mobile phone is with you and it is your ownership, it will be considered, the risk of that asset belongs to you, so it will be considered as a constructive, it is in your constructive possession. So in constructive possession, although the asset is not physically with the owner, but the risk of the asset and the ownership of the assets is with the owner. So whoever has that risk and ownership of the asset, that asset will be considered in constructive possession of that party. Now here we want to describe the Murabaha, how it can be executed by the Islamic banks. So the best way for Murabaha according to Sharia is that the financer himself purchases the commodity and keeps it in his own possession. The sale cannot take place unless the commodity comes into the possession of the seller, but the seller can promise to sell. So although this is ideal situation that the Islamic bank, if they want to finance an asset, they should purchase that asset, get the ownership and possession, and then they can sell it to the third party. But obviously there are some issues involved in it, because if the Islamic bank is selecting or purchasing the asset, the client might have certain objections on this transaction. In terms of the price of the commodity, the client might not be satisfied. Quality of the product, that might not be according to the choice of the client. So these sorts of issues can be there, because of which the Islamic bank generally they do not purchase the assets, rather they adopt a procedure which we'll discuss in the next slide, which is basically a 5-step process in which the Islamic bank execute this Murabaha contract. Number one, first of all, the client who is interested in purchasing some asset, he will approach the Islamic bank, and then they will discuss the terms and conditions, and then once they are satisfied with each other terms and conditions, they will sign an overall agreement which is called Murabaha by purchase order, or MPO. So this is the step number one. In step number two, the Islamic bank appoints the client as his agent for purchasing the required commodity. Now here we can see the difference. We said ideally the asset should be purchased by the Islamic Bank. But here what practically is happening, that Islamic Bank, rather purchasing that asset, uh, they are appointing the client to execute that transaction on behalf of the bank, and that is done in order to avoid the issues or the objections that the clients might have in terms of the quality or the price or the whatever related to the product. So this step number 2 is called agency contract. Step number 3, we can see the client purchases the commodity and takes its possession as an agent of the institution, right? So client is purchasing on behalf of the bank. So client has ordered the product, he has received the product. Now the physical possession is with the client, but actually the ownership and risk of that asset belongs to the bank. So it will be considered in the constructive possession of the bank. Step number 4, the client makes an offer to purchase the commodity. Since this asset is not the client's property as yet, so he is informing the bank that he has ordered the client has ordered the product, he has received the possession of the product, he has verified the shipment. Once he's satisfied with the shipment that it is received according to the order placed by the client will inform the bank about all these things that have happened, and then the institution accepts the offer and the sale is concluded. So at step number 5, once the institution or the bank, Islamic Bank, accept the offer of the client, here this Murabaha transaction is going to conclude. Now the transfer of ownership takes place after this step. It means that now the asset belongs to the client and Islamic Bank has sold that asset to the client, and the amount is to be received by the Islamic Bank. Now this amount generally is collected in installments. The most essential element of a Murabaha transaction is that the commodity must remain in the risk of the institution between the third and fifth stage that we discussed in the previous slide. Here the third stage is the possession by the client, and fifth stage is the institution accepts the offer and the sale is concluded. So before this step number 5, the asset is the property of the Islamic Bank. After this step number 5 is executed, the asset will become property of the client. The institution may ask the client to furnish a security to its satisfaction for prompt payment of the deferred price. Now here in case of Murabaha that is executed by the Islamic Bank, the payment is deferred, which is called Bay Muajjal. Now there is a risk involved that the client might not be able to pay the full payment that he is supposed to pay in installments. For that purpose, the Islamic Bank can ask the client to furnish a security, so that in case the client fails to make the full payment, Islamic Bank can recover the cost of that or recover the price of that asset from that security that is provided by the client. Okay, now we move to the second part of our lecture, which is related to the different issues which are related to Murabaha financing. Now, one of the objection of general public is with respect to the pricing mechanism that is adopted in case of Murabaha. As I told you earlier, that in case of Murabaha, the profit can be expressed in terms of percentage, and generally in case of banking, that percentage is the standard rate of interest, which is CIBOR, the standard rate of interest which is decided by the state bank. So that is the reason that the price in a Murabaha transaction is always higher than the market price. This increase in price in a credit sale is analogous to interest charged on a loan, since in both the cases an additional amount is charged for deferred payment. So what the client face when he negotiate with the Islamic Bank, that the asset that he can purchase from the market, let's say if that asset is of 10,000 rupees, the Islamic Bank if that asset is acquired from the Islamic bank through Murabaha, the Islamic bank will charge markup on it. So if the client wants to pay uh, in in within 6 months, the markup will be a little less. Say it's 5%. If the client wants to pay the whole price in 12 months, then the markup will be higher. Say it is 8%. So something which is similar to interest-based loan. So the clients sometimes they get confused that okay, now what is the difference here, because the same rates are applicable in case of loan they are getting from the conventional bank, and the same type of markup is being charged by the Islamic bank for the assets they are selling on Murabaha. So the difference here is that in capitalist economy, money and commodities are treated alike so far as commercial transactions are concerned. So in capitalist economy, money is treated as a commodity. But in Islamic economy, money and commodity are treated differently, means money is not treated as a commodity. The reason why money is not treated as a commodity, there are three reasons for them. Number one, money has no intrinsic utility, whereas commodities have. So money is basically, if we talk specifically about this paper currency, so this paper currency, let's say if we have a currency note of rupees 5,000. Now this paper, uh, this note, currency note is just a piece of paper. The only value it is getting is because of the State Bank of Pakistan, uh, which has issued this note. If at a certain point in time, State Bank withdraws or declares this 5,000 rupee note declares it not to be a legal tender anymore, then in that case, this note, 5,000 rupees note will not be not more than a piece of paper. So that is the reason that Islam money has no intrinsic utility. Rather, it is drawing its value from external source, which is the State Bank of Pakistan in this case. Different units of money of same denomination have same characteristics, where different units of a commodity have different characteristics. So that is another difference between money and commodities. And the third difference is, in case of commodities, the purchase and sale is always for a specific commodity, whereas in case of currency, you are indifferent whether you are paid one note or the other note, as long as it is a legal currency note, you are you have no issue with accepting any any unit of it. So that these are the three difference because of which in Islamic economy, money is not treated as a commodity. Okay, now the price can be different based on different factors. So the time is not the only factor involved. Like in case of Murabaha, the client get confused that the difference in price is only because of time. But if we look practically in the market, the price of the commodities they differ because of many reasons. One of the reason can be location of the shop. You find that those products which are sold in premium outlets, they are generally priced higher compared to those which are sold in general market. Similarly, the seller who has a goodwill in the market, he can charge uh, premium price because people trust, and people have this belief that this seller is not going to compromise on the quality, so they are ready to pay a little higher price on that. Similarly, certain shops are charging higher price because they are offering uh, some additional services which are not offered by other businesses. Sometimes the customers are able to get a special price because of the relationship with the seller. Sometimes the buyers or sometimes the customers are ready to pay a higher price because of the convenience factor, or maybe they feel that the store is hygienic, or the conditions there are hygienic. So for that purpose, they are ready to pay a little bit higher in that case. So all of these factors affect the price of a commodity. So time is not the only factor that is affecting the price of the commodity, whereas in case of money, since it has no intrinsic utility, the only factor that is affecting its value is the time factor. So this is another difference between the uh, currency and the commodities. So owing to these differences, we can say that the seller, if he is charging different price for cash and credit, it is absolutely allowed in Sharia, and there is no objection on that, unless uh, as far as this extra amount that he's charging is within reasonable limits. It should not be an exorbitant amount. So that was basically the part one of the lecture that we covered. Now moving on to the part two of the Murabaha, we continued with certain other issues. The second issue that we discussed was this use of Kaibor as a benchmark. As we discussed earlier, that in case of Murabaha, the Islamic banks, they are charging profit over, and they are declaring the cost, or the cost is known to the buyer, as well as the profit that the Islamic bank is charging. Now, this profit is determined on the basis of standard rate of interest, which is Kaibor, which is decided by the State Bank of Pakistan. So, some people have this objection on it, that on one hand, Islamic banks are practicing Sharia, on the other hand, they are following interest rate, or they are adopting interest rate as a benchmark for calculation of their profit. Now, in Islamic Sharia, the profit can be determined on any basis. You can set any criteria for determination of profit. So it is absolutely right if the Islamic Bank is following the rate which is decided by the State Bank of Pakistan. So using Kaibor as a profit uh, benchmark for profit, it does not render Murabaha transaction uh, illegal from Sharia perspective. So that is the only thing that obviously the interest-based loan, there is a resemblance of this Murabaha with the interest-based loan. So which should not be there actually. The state bank should come up with a different rate for the Islamic banks. But as we know that the share of the Islamic bank in overall marketing is very low. So right now this is not being done, but as soon as the Islamic banks will gain a bigger share in the banking sector market, so in the banking sector, they will definitely, we'll see this difference, that the Islamic bank is going to come up with a different rate for both the systems. Okay, another thing that is objectionable to few people is that once you go for a Muraba transaction with the Islamic bank, one of the requirement of the Islamic bank is that they ask you to sign this promise to purchase. Basically, it is a legal document which states that you are bound to purchase this commodity from the bank. So why Islamic Bank is doing that, why they are asking the client to sign this document, the reason behind is that Islamic Bank wants to ensure that if they are, uh, they are committing certain funds for the purchase of that asset, then whoever has demanded that asset, obviously that is the customer who has demanded that asset, he should honor his commitment and he should purchase that asset from the bank. Because if that customer, he backs off from the contract, and you know he comes up with this, that he is not ready to purchase that asset, in that case Islamic Bank is going to uh, Islamic Bank will be in an awkward situation, because they have committed their funds and now they are not finding a buyer of that, or a buyer, either they are not finding a buyer, or they are finding a buyer, but the buyer is not ready to pay the price which they have negotiated with the original customer. So that is the reason behind this promise to purchase document. So here it is mentioned as well, that after the commodity has been purchased, the client might refuse to purchase the commodity. To avoid such a situation, the financier requires the clients to sign a unilateral promise to purchase. So we have discussed here the rationale behind this document which is obtained by the state bank, which is obtained by the Islamic bank. So one should not have any objection, keeping in view what is the objective of this document. So now talking about the promises, generally it is the concept that generally the people I have this view about the promises that they are moral obligation and they cannot be challenged in the court of law. But uh, this promise to purchase, which is a document signed by the Islamic Bank, is a legal document which can be challenged in the court of law. Uh, so, for promises that can be challenged in the court of law, there are certain requirements which are discussed here. That it should be one-sided promise. The promise must have caused the promisee to incur some liabilities. If the promise is to purchase something, the actual sale must take place at the appointed time. If the promiser backs out of his promise, the court may force him either to purchase the commodity or pay actual damages to the seller. So, yeah, based on this legal document, the court will force the promisee to purchase the product because he has made a commitment, he has promised to do that, and in case he failed to honor his commitment, the Islamic Bank will, the court will allow the Islamic Bank to go for the auction of the product or asset, and if in case there is any loss in that auction, that loss will be paid by the that is what here it is mentioned, that this loss or the actual damage which will be suffered by the seller is going to be paid by the promisee. Okay, so the risks which are involved in Murabaha, one of the risk is non-payment, and to ensure that that does not happen, the client make the payment which he has committed. For that purpose, the Islamic Bank can ask the client to provide a security. Uh, the security can be an asset, which generally is the case when the amount involved is a reasonable amount. You get if the amount is some it is towards the higher end. In that case, the Islamic Bank asks for security. If the amount involved is towards the lower end, not substantial amount is involved, in that case, the Islamic Bank can ask for guarantee as well. So, in case of guarantee, the guarantor, whoever is giving the guarantee, he undertakes this. He makes a commitment that if the original buyer fail to make the payment, then this guarantor is going to make the payment. So this arrangement can be made, but one thing that is important here is that the guarantor cannot charge a fee for providing guarantee except any charges he has incurred in signing up for his agreement, for this agreement. So that guarantor should not be, that it means if the guarantor can be there, but that guarantor will not be paid for this service of guarantee. Okay, now second risk that is involved in this Murabaha is the client might not pay on time. He might delay the payment. So in order to discourage this delay in payment, there are two alternatives. One is the compensation method and the other is the compulsory charity. In compensation method, some contemporary scholars have suggested that dishonest clients who default in payment deliberately should be made liable to pay compensation to the Islamic Bank for the loss it may have suffered on account of default. So it means in the contract of Murabaha, it can be defined that what penalty will be charged from the client who fails to make payment on time. Uh, However, the majority of the present day scholars do not accept this concept of compensation due to several reasons. One of the reasons is that once you have settled a price, it cannot be increased because of delay in payment. This is one of the rules of the credit sales. So, because of that reason, this compensation method is not accepted by the scholars. The second alternative to discourage delayed payments of loans, or in this case, which is the price of the Murabaha. Uh, so in case of Murabaha, at the time of the contract, it can be decided that if the client failed to make payment on the due date, he will be uh, liable to make certain contribution towards a charity. Now, the amount of that he has to contribute will be defined in the contract, and that amount of charity will be collected by the Islamic Bank, and it will be further distributed, or it will be used in charity by the Islamic Bank. So while implementing this proposal, some points will be kept in mind. Number one, that the amount of penalty is defined in the contract. Number two, this amount of penalty is collected by the Islamic Bank. And number three, Islamic Bank should use it for charitable purpose. Now, uh, whether this amount of penalty charged by the Islamic Bank is used for charity or not, for that purpose, there is Sharia audit which is conducted by each bank, and this Sharia advisory board ensures that all the amount which are collected through penalty are spent for charity. Uh, okay, so another issue which is involved in Muraba is this concept of rollover. The, this rollover is practiced in conventional banking, where uh, in an interest-based financing, if a customer cannot pay at the due date due to any reason, he may request the bank to extend the facility for another term. Okay, so that happens in case of interest-based loan. Now, remember, Muraba is not a loan; it is a sale. So it cannot be, this concept of rollover cannot be applied in Murabaha. Some Islamic banks who misunderstood the concept of Muraba started using the concept of rollover of Muraba as well. The role of Muraba is nothing but interest, pure and simple. Okay, so another issue is that whether some discount or rebate can be offered in the contract of Muraba. If the borrower makes an early payment, then the agreed date, should the lender financer allow him some discount for it, means whether this discount will be declared in the contract. So here some scholars, they have pointed out an incident which happened that day in the time of the Holy Prophet, peace be upon him, that to support this type of rebate, some scholars quote the example of Banu Nazir, a tribe exiled from Medina, that the Holy Prophet ﷺ gave them this option, that give discount and receive your debts soon. Now, uh, this is the argument which is given in support of this discount. The argument is not acceptable. Why? Because here we are talking about a loan, and Muraba is not a loan. So how can we apply the rules which are applicable for loan uh, uh, to a sale transaction? In research terminology, this is an analogy. This is an uh, you know uh, so this is referred to as comparing apples with mangoes. Like if you are conducting research on apples, you cannot include the data of mangoes in that research. So here when we are talking about sales, how we can apply something which is related to loans. So that based on this argument is not acceptable. It means that this clause cannot be part of a Muraba contract, that certain discount will be offered if the client is going to make an early payment. So remember the rule in case of Murabaha, no discount can be offered for if the payment is made early. Similarly, no extra amount can be charged if the payment is delayed. Although here some extra amount is being charged, but again that is used for charity. That is not something that is going to be part of the profit of the bank. Okay, now calculation of cost in Murabaha is requirement because if the cost is known, then we can sell it on Murabaha. If the gas cost is not known, then we can sell it on the basis of Musawama. The issue arises in calculation of cost once we are dealing with foreign currency. So, how to deal with the issue of frequent changes in foreign currency exchange rates? The bank can charge from client in dollars to avoid differences of exchange rates. So, of the one method to avoid this controversy of you know uh, different exchange rate or the exchange rates being changed, be, exchange rate being changing on daily basis. To avoid that situation, let's the Islamic Bank can keep the whole transaction in foreign currency to avoid that issue. Secondly, if the bank has paid by converting Pakistani rupees into dollars, the same amount of rupees can be taken as a cost price and the profit of Muraba can be added upon. How to determine the cost if the payment to the exporter is to be made at a future date or in installments? So, what if the Islamic Bank has also purchased on credit? In that situation, since the exchange rate fluctuates on daily basis, the exact cost cannot be determined till the final payment is made. The bank can sell the commodity to client after the final payment is made so that exact cost is known. That is one option. Second option is that the bank determines the Muraba price in foreign currency rather than Pak rupees. So just keep the transaction in foreign currency to avoid that issue. And the third is instead of Murabaha, the deal may be done on Musawma. Why? Because unless and until the Islamic Bank has not paid the full amount, uh, the cost cannot be determined. So they can deal on the basis of Musawma rather than on Murabaha. Okay, now rescheduling of payments in Murabaha. Rescheduling means extending the period for installments. If the installments are rescheduled, no additional amount can be charged for rescheduling. The amount of Muraba price will remain the same in the same currency. Now, some Islamic banks propose to reschedule the Muraba price in a hard currency different from the one in which the original sale took place. But again, this arrangement was not approved by the Sharia scholars since the benefit here is coming because of the delay in the payment and the Islamic banks are not supposed to receive any extra amount because of the delay in payments. The last issue is related to the securitization of Murabaha. Securitization is referred to as a process where we issue negotiable instruments against an asset. Now, negotiable instruments include shares or bonds. They can be issued once we have an ongoing business. Means these the, securitize, the securities can be issued against uh, ongoing businesses. But here, in case of Murabaha, it is a sale transaction in which profit can be received only once. Means it's a uh, deal where the Islamic Bank is going to sell the asset to the buyer. Once the asset is sold to the buyer, then that profit is documented and then it will be received in installments. So basically, it is one-time transaction. Means the profit, whatever, although it is being received in installment, but it is one transaction that is giving us all this profit. So uh, securities cannot be issued for one-time transactions. So that is the reason this Murabaha cannot be securitized. Muraba is a transaction which cannot be securitized for creating a negotiable instrument to be sold and purchased in secondary market. If the client in a Muraba transaction signs a paper to evidence his indebtedness towards the bank, the paper will represent a monetary debt receivable from him and hence it cannot be transferred to a third party except at its par value. So with this we come to the end of this lecture on Murabaha. So we covered almost uh, all the points, right? We started with the definition of Murabaha, then we discussed the features of Murabaha, Murabaha as a mode of finance we covered, and then we covered these 11 issues which were related to Murabaha financing. So that's all from my side for this lecture for today. Hopefully, the things have become more clearer to you after going through this lecture. Thank you very much for being with me. Hope to see you soon again. Allah Hafiz. God bless.